Hi, Joe. So I'm happy to have you on my podcast. Today we'll talk about a lot about different types of VC investments, about Europe, and also about secondaries and the fund of funds model. So great to have you.
Thanks, Max. Really nice to be invited and to talk with you at length today.
Yeah. So first of all, I'd like to ask a bit about your story. So you moved to Europe a long time ago, and if you can share a bit of the insights, why you moved to Europe, and also you earlier were involved in private equity, but then you moved to mostly to VC. So if you can also share a bit about this transition, would be great to hear.
About my own story, sure. Well, I grew up in the US, in Massachusetts, which is on the East Coast. And I grew up in a place where General Electric was the big show in town. And my dad was an engineer and worked there, and my uncles. And so I grew up in a kind of engineering family. And I wanted to study music. And my father said, "No, you study engineering." So I did, studied electrical and computer engineering. And I finished in the mid 90s when the world was digitizing, everybody needed IT. So the first 10 years of my career were running IT departments, first in a bank in the US. And then I did quickly move to Europe in 1999, pretty early in my career because I thought I had been a tourist in Europe and I thought living and working in Europe was a very different thing. And I could use my tech skill to get a job and to see how that was. Well, now it's 26 years later, 27 almost, and I can say it worked out. It was great.
Super.
I quite enjoyed working across culture. We had, in my manufacturing operating days, we had factories in about 12 different countries, and I was the head of tech for that. And that was really a great lesson in, building software that could integrate factories and production and supply chain. And we had development teams and so on. And back then it was a lot of, do we buy software or build software? And that was really a lot of the decision being made. A lot of things had been built in-house for most corporations, and you were seeing the rise of the software markets produce solutions that you could, adapt and plug in to your ERP or whatever. So that long story, I had a 2 to 4 year expat contract. Absolutely loved the working across cultures, and I discovered that if you could use tech to defragment economies and supply chain and so on, you could create a lot of value. I did an MBA at London Business School, and I learned in the early 2000s what venture capital is. And in the company, we were writing software, we had development teams and integrating systems, and I learned that entrepreneurs do that outside, create a lot of value, and they need money, and that funding comes from VC. There wasn't a lot of VC in Europe at that time. It was an earlier cycle and not super successful. So I worked on some startups myself. I co-founded a company. They all failed. I'll shortcut the story and say they all failed. You always learn a lot more from your failures than you do from your success, and I did learn a lot. And so I then went to work at Cambridge Associates, really learning the investment side. As you said, mostly private equity. I was a private market specialist for Cambridge, working in London. I worked a bit in Boston in the early time there, but mostly in Europe, building portfolios for pension funds and family offices and some sovereign wealth funds as well. And that was really interesting to do because I had clients with great amounts of capital to deploy and really global outlook. So we did probably 2/3 into private equity, classic buyout stuff, maybe 15-20% venture capital growth, and then the remainder opportunistic secondaries, and then the beginning of private infrastructure, a bit of real estate funds, and so on. So, I got a really great education. Cambridge is an amazing firm, and it was wonderful. And I got really interested in being a tech guy. I was on Cambridge's committee for VC and also for secondary and fund of funds. And so I learned a lot about the best fund of funds and how they operated. I invested in a lot of the best secondary funds. And then I went and worked for one. So I worked again in Europe for an American firm called Pomona Capital, which is one of the pioneers of secondaries, and was a great place to be. I learned a lot. The firm did some amazing deals, and it was fascinating to buy things that we'd been primary in, in the Cambridge days. And so that was a great lesson. And during that time, really, Europe was starting its what you might call tech renaissance in a way after the financial crisis. So founders were building tech in a different way at low costs and high velocity, and they could address global markets because of app stores and so on. That didn't happen before. That was pretty new. And so, putting together my career of tech and primaries and secondaries, I started Isomer. What do we do at Isomer? Tech, primaries, and secondaries. All Europe, all tech, all the time.
Super, super, Joe. I think you succeeded, even if you didn't launch your own big unicorn, but still you have a huge fund, or like several funds. If I researched it correctly, you have about 850 million AUM. Is it correct?
Something like that. Yeah, yeah, exactly.
Yeah,
We have
and
six funds altogether between fund to fund, secondaries, and separate accounts.
yeah, and you've done 100 deals as LP in funds. Is it correct? From Isomer?
Yes, I think technically, to be perfectly accurate, we've closed 96. There are
Mm-hmm.
two in legals now, and yeah, so we'll cross the 100 mark pretty soon. Not that that's a
Super.
goal, but it's a
I
significant
think it's one of
milestone.
the most popular funds of funds in Europe. I don't know whether there are some who did more. And then you have 44, at least on your website, unicorns, maybe already more in your across your portfolio of 2,000 plus companies.
Yeah, correct. We do three things really. We invest into seed funds as a primary investor in order to have a great return and diversification and all the things that come from that, but also to have eyes and ears everywhere in the market. Europe is a big place, and when you study those unicorn outcomes, they're everywhere. They're not. It's not all about the UK. It's not all about Germany. It's not. They're really in every country. There are 100 cities with unicorns now in Europe. So that's both very exciting, but a big challenge. I think now we have 51 actually. So we're getting a new unicorn about one a
Wow.
month, if
Hmm.
not more often. So, and we're really tracked that very closely. We're really proud of that, partly because when we started Isomer, there were about 20 unicorns in all of Europe. I mean, it's hard to imagine, right? But there hadn't yet been many successes. And today, depending which database you believe, it's between 350 and 600. So Europe
Wow.
has been extremely successful at building good tech companies. And I think for us, unicorn's not the answer, but if you're doing good investing, you should have an output of, a number of significant, serious tech companies. So it's kind of a metric in a way. Although what matters is at what price did you enter? How much did you buy,
Yeah,
and at
yeah,
what
yeah, yeah.
valuation?
And what is your investment thesis? So let's put all together all different types of deals that you are interested in 2026. So secondaries, if you can describe like what is your check size and what type of deals are you looking for. So I think this would be interesting for the audience.
Yeah, sure. So we do three things. We do the primary seed fund investments. We then co-invest into companies together with those VCs. So as their companies start to grow and they run out of money, we can join together with them. And then the third thing we do is, as you hinted, we buy secondary pieces of both. And we started that really from day zero, just by saying to our fellow LPs, we're on the LP advisory committee of most funds. And so when you're, at the annual meeting or you're on the LPAC meeting, you can say, well, the fund's getting old now. If anyone wants some liquidity, we're open to buy more. And we've done that for 10 years, really within the portfolio. The other thing is when founders want some liquidity, right? When you see in Europe a lot of founders who've built a lot of equity through their hard work, sweat equity, but they don't have their own house yet. So it's a funny, I call it our cash for houses program sometimes. So you see founders or angels or, the early investors who want to take some risk off the table and some liquidity. So we do buy some company stakes like that as well. And the thesis was, okay, way back in 2015 when we started, if you talk to entrepreneurs and saw what they were building, it was remarkable. Never saw that in Europe before. I had seen it in the US, having invested there, but it was really exciting. And so that's great, but highly diversified in terms of sector, in terms of geography, even in terms of different stages and funding, pricing and sizing and so on. And so we thought, well, the best way to approach that would be to try to partner with the smart money. And the smart money is really those seed funds, those people who put the first professional money into companies all over Europe. And there's one group in Northern Europe and a different group in Eastern Europe and a different group in the South. And so we spent years and years flying to all those countries, speaking at the conferences, meeting all those VCs, really with this idea that if you're a great founder in Eastern Europe, building something great, who do you go for your money and your help, in those early days? If we can figure out who that is and partner with them, that would give us insight, intelligence, access, and good returns. And so that's really the idea was that. It's hard to understand all of Europe. It's a diverse place. But if you have those partners everywhere, then you can do interesting things. Then you can spot companies growing really fast, and you can co-invest with them in those early days where they're not super highly valued yet. They need your capital for that, product. I like the moment where they've kind of found product market fit pretty much. The product selling, you can maybe talk to some customers, see they're using it.
So
And
it's
then,
about Series A.
yeah, so, I mean, companies call it different things, right? Sometimes it's A, sometimes it's A plus, pre-A, B, C, it's I hesitate to use the label ABC because, you find sometimes it's called a B, but it's really I don't know, wouldn't even be called an A in the US, but in Europe it's a B. So we don't really use that.
Yeah,
We
understood.
use the stage of the product. And hopefully our money's going in on when we're co-investing is going in to help them scale something that's kind of working. Our VCs are taking that product build risk. We're taking the scale up risk. And then with secondaries, it's even then later. So it's kind of multi, right? Secondaries is like, okay, it's really working, but it's your original investors are getting tired. They wanted their cash back a little bit earlier. They maybe got a good return on paper, but so that's really fun. So sometimes we've been following a company for, 5, 6, 8 years, and then you have a chance to buy into it. I mean, super cool, right? Especially when founding teams that you really like, you say, we missed that one, your anti-portfolio. We have a beautiful anti-portfolio, but secondaries allows you to buy in and be part of that story and provide liquidity, which is super helpful to those groups as well.
Yeah. And this is everything happening only in Europe. And what are other restrictions? So, like, in what type of deals you don't invest, and what is typically check size when you invest in funds as an LP and in secondaries and directly?
Yeah. So yeah, we focus on Europe. There are groups who do this in the US or groups who do this in Asia. So we don't want to compete with them. We want to really be the experts for Europe. So everything we do is within Europe. We use the Eurovision Song Contest definition of Europe. So we include the UK, we include so EU plus plus plus, right? I mean, when I started the firm, UK was in Europe, so it still is in our mind. On a fund, we like, if we can, we like to be like 10% LP. So if the fund is 50 million, 5 would be great. If it's 80 million, 8 would be great. We like funds that are focused on that seed stage, and ideally they're less than 100 million in size. That's really where we think the highest multiples can be made, and then really they're doing the first check. Of course, when these firms are successful, they raise larger funds. So you loved it at 80, you love it at 100, you probably still love it at 120 when it's 200 or 250, So we really try to focus there. Also as a service to our LPs, right? So we're offering access to that market to institutions. So there's a very natural thing that happens. You say, well, when our successful firms grow big, that's when our LPs might invest directly in them. So we offer that handoff to the LPs. So we do anything between sort of 1 and 10 million typically, sometimes a little more. And then we do a basket of micro funds. We love micro funds. Why micro funds? Because that's where the experiments are. That's where somebody spins out of a big group and they're testing a new idea. Could be a sector thesis, could be a deal flow thesis or a talent thesis. We see different models, but micro funds like sub 50 funds, they tend to be 20-ish, 30-ish. And that's where you can really back some amazing talent and big ideas. And when they perform, they go crazy, right? It's not 3x, it's 5 to 10x. So we love those. We do a basket of those, and we're doing, if it's a 20 million fund, we're doing 2 or 3 kind of commitments. And then with co-investments, we tend to do anything between about 1 and 5 million, which is tends to fit in what you were describing, the A round, or call it A, right? But there's a round of 20, and we can be part of that. A lot of the capital will be spoken for by existings. We take the pro rata of our underlying funds quite often, or just, we've made a pretty good name for ourselves as a helpful co-investor. So sometimes we're going in with the VC. So that's, tends to be between 1 and 5. If there's excess capacity, we offer that to our LPs again. This is a group of LPs who like to also come in with another, anything from, I don't know, 1 to 10 million. And then on the secondary side, that's really variable. What are people selling? And we go down as low as 1 million and up as high as 15, kind of in that zone. And quite often we're making an
Mm-hmm.
offer. We're saying, well, we'd be interested to buy, but it's not clear who would sell or how much. So that's the weird thing about secondaries, right? You make an offer, say, to all LPs of a fund, and you don't really know if 2 million of interest would come back or 10 million of interest, or until you make the offer. So that's, secondaries are quite different in their format.
Mm-hmm. Okay, understood. Yeah, and let's talk about why Europe is so attractive for venture capital now, and why is it different from the US? And like, are valuations lower, or are some founders have some different mentality? So, like, how can you compare US VC and European VC, and why European is interesting for LPs and VCs to invest?
Yeah, well, there's lots of answers to that. That's a huge question. Tough one to tackle, unless we have a beer in 3 hours. But I guess that from a top-down point of view, Europe is now about a third of the global venture market. So if you're a large allocator and you're missing Europe, I think you're really missing a strong return and a strong diversifier to your portfolio. So from a top-down point of view, right? There was a question mark 10 years ago. Was Europe going to generate great tech and great companies? And the history of Europe wasn't so good in commercialization. Always been good in tech, right? The web was invented here, right? I mean, in tech terms, 5 of the top 10 computer science universities are in Europe. So there's never was a question about is there good technology, but could it be commercialized? And so what's exciting is that you see the US method of VC being applied in Europe, and that works really well. From a bottom-up standpoint, you really need to meet the new generation of founders. They're ambitious, they're hardworking, and they read the same white papers as developers everywhere, right? And that playing field has really been leveled. I think 20 years ago, in the old days, um, the cluster effect was more important because information didn't travel. So you sort of had to be close to where the tech was being developed or where companies were being built. Whereas now, information flows very, very freely. Something happens in California and it's known in Berlin, within the hour, right? And vice versa. So this idea that things are really local is kind of gone, except that at the beginning, companies are always local, right? It's a few people building a product, and But in terms of tech, they're using exactly the same methods, the same software tools, the same. So the system of developing companies is exactly the same. However, Europe having 500 million people, a different consumer base, different appetites, different corporate buyers and stages of development and use of robotics in factory, it's very different. So the solutions developed in a European environment are very different than quite often than the solutions in an American environment. So I don't think it's either or. I think it's and. And you see, companies depending on the sector. A lot of companies start in Europe and go to the US because that's their natural market. I think enterprise software is a good example, right? If you're running an enterprise software, you really want to get to the US where many of your best customers would be. But anything consumer focused probably is going to be a European thing. I mean, fintech, for example, right? Highly regulated. The way people use financial tools in the US is different. So Revolut's going to the US, as we read in the paper. Let's see, right? Extremely successful fintech in Europe. I think it's, when I look at the American tools, people write paper checks, right? That's gone out of Europe for many, many years. So it'll be interesting to see if that really is adopted and works well. And then you can really go sector by sector, whether things stay local or go or regional or go, across the ocean. So sorry, as usual, that's a long rambling response to why Europe. The valuations are lower, so that makes it attractive, right? If you're an early stage investor, you're buying development and revenue at a lower price point, and therefore your potential multiple could be higher. The later the stages of the company fundings, the more they reach, say, global pricing, right? But you see most of the late stages of European companies have American money in them. So I think for a lot of the American firms, they come to Europe because they find great tech, better prices. So that's always amazes me. The up rounds in some of our companies are the Andreessens and the Sequoias and groups like that. And I think for us, they pay a high price, but for them, they get a discount.
Yeah, super, super understood. Let's talk about the fund of funds model. So I have many questions, but let's start with how do you select as an LP fund managers? So you already talked about some micro funds when there are some experiments and you can bet on different new emergent fund managers. And there are also, so if I understood correctly, you have a list of a network of partners, GPs that you invest maybe once, twice, and third time. So out of 100 fund investments, how many of them are in the same fund managers, and how do you typically select new ones?
Yeah, again, a big question. So we start from strategy. Like before we consider managers, you really start from, okay, if I want to access the best of early stage Europe, where do I see that? Think about the market. Where's that evolving? Well, it's certainly very big in the UK, single biggest market, very big in Germany, very big in France. There's a Nordic part, there's an Eastern European part, there's a Spain southern part. And so the first thing we do is sort of, well, how can we cover that in a sensibly sized portfolio, right? Because you don't want to make too many commitments, but you don't want to make too few commitments. So this is a subject of hot debate. How many commitments could you afford in the UK, right? And how many to cover Nordic countries and so on. So starts with strategy. Then we say, okay, let's go to each country and meet everybody and talk to everybody. That's a big job. Been doing that well, you could argue been doing that for 20 years, been doing that in a very focused team way for about 11 years. And we meet everyone, we speak at all the conferences, and part of it is just understanding what are the fast moving companies and tech and what's being successful, who's investing in those things, what investment theses are coming out. And we really do, map every country. That's a big job. We've met, last time I looked, 1,950 VC firms. They're all managing, say, 2 to 4 funds. So, that gives you a sense of the fund universe. That's who we've met. I think there's probably a similar size group that we haven't met who are doing, university attached funds or local development funds or whatever. But that's a big universe. And then from there, we start to say, okay, well, who's in each market, who's really the some of the strongest teams for doing that first professional check? The question we're trying to solve for is if I was a really great founder, if I built something really hot and I'm in the luxury position to select my VC, who would I want? And so we ask entrepreneurs that question, and quite often the VCs we that are the answer are people who have been founders themselves, built a successful company, so they have a good understanding of how to help the next generation, and they exit their company, they do some angel stuff, and then they go pro VC, right? So that's a very common profile in Europe. We like that profile. We look for that profile. Many of the great VCs of Europe are that profile. There's another group which is people who worked at big firms. They worked at Excel or Index or Bulletin or wherever, and they had a great experience, but they really want to do that early stage, and they have a different idea of maybe a sector focus, maybe some concept they've been thinking about for years. They leave the big firm and they start for themselves, and so they're experienced, they have their own deal flow and so on, but they have a different thesis. That's very interesting. Sometimes they team up with the former company builder, who went to angel. That's exciting. And then the third profile we see a lot is the big tech executive. So somebody who worked at Google, Microsoft, Apple, they tend to be in the startup incubation unit or strategy unit or whatever. So in recent times we backed someone who used to run Google Campus, for example, loved by the startup community, has a real thesis about which startups that she'd like to invest in, and so but it gives you an idea, right? So we're going to every place and trying to figure out who are those leading investors who could build a really strong deal flow, have strong investment instincts, and we build it's kind of like a puzzle, right? You're trying to build this picture of Europe. We then, commit to their funds, act on their advisory committees, try to be helpful to them, pay it forward, and then watch all their companies, and then try to participate in co-invest and follow on. So I don't know if that answers your question. How do you select
Yeah,
managers?
super. This is a great insight for emergent fund managers that actually, in order to get investment, they need to be such a resource for founders that founders will point
Yep.
to them and say that, yeah, I want this fund manager in Spain or in Germany to invest in us.
Yep.
And this is actually reverse engineering on how you can not show like great projections of your DPI in 5 years or 10 years, but to think on how I can make a founder willing raise from my fund. So I think it's
Well,
great.
to double click on that a little bit. So what I find myself saying to new VC firms these days, kind of back in the 2013, 14, 15, if you just had some money that already distinguished you, if you're a seed fund, right? There weren't many. And so having capital was a competitive advantage. That's no longer true. And what you've seen is the firms that started back then, they're on fund 3, 4, 5 now. They've developed, they've probably become more focused on what they're really good at. So if you're starting a new firm today, you can't just be a general VC. And that we see that too often, to be honest. Oh, we're a VC firm, we're investing in software, in this area. Well, okay, but that's not enough, right? Why? No founder, to reverse engineer it again, no founder is going to say, I really want to work with them because they're software, right? No, you have to be really specific. We look for this kind of company. We've done this in our background, and therefore we have a real skill here. And I'm open to different definitions of what that thing is, right? That thesis is. But you got to have it. You got to be special. You got to be differentiated. And this is not new. Americans have been saying this for decades. This is normal in a mature market. But Europe is now at that stage where it's not enough just to have a fund, right? You have to have a fund really focused on a specific thesis in order to win.
Yeah, and what might be this thesis potentially? So I understand vertically focused funds that, for example, specialize in healthcare or fintech, or like when you accumulate some specific expertise and you understand the market, and maybe you have some media resource in this market, so you can see all the deals in your specific vertical. But what might be like the best examples of value add from VC firms to startups? So have you seen some interesting ideas on how emerging fund managers can position themselves initially that, yes, I'm not only investing in this specific vertical, but I also will somehow support these founders. So what are the types of support that you saw and you think is great type of support from VCs to founders?
Yeah, yeah. I mean, this is again a big question. You see, ideally, the types of support that VCs are offering is connected to their thesis. So I'll give you an example. There's a firm in Europe that focuses on companies that are based on network effects. So network effects is, you know, where every additional node creates value. So marketplace is one of the most obvious examples, right? And so this firm's thesis is that network effects businesses will be powerful over time and will be applied to every sector. And so they really have become experts in how to generate network effects, how to go from your first 10 customers to your 10,000 customers. And there's some really specific special strategies. So they're to their founders, they're not offering a general random, I'll be your friend on the board. They do that, of course, and they do all the normal governance. But the thing they're really bringing to the table is we have invested in, I don't know how many now, in their case, I mean, at least tens of network effects businesses, many of which have gone multi-billion in size, and many have exited by now. And if you really need a network effects specialist around your table, if you're building that kind of business, these are the guys you need. And they've proven time and time again to be the CEO whisperers. You know, they're very quiet. They don't make a lot of PR about themselves. But when you need that skill, that's the group, right? Just to give one example.
Yeah.
There are, and you know, 10, 15 years ago, that never would have occurred to me that you could create a whole firm on that idea. But they did, and they've done super well. You can do similar things, as you said, always a sector focus. But I was trying to think of non-sector, so that cuts across all sectors. We have other groups who do like automation, like software tools. So giving their founders, once you become a portfolio company, you get a whole batch of tools, from document templates to funding advice to HR. Recruitment is always a thing, right? A lot of VCs are helping you find the top talent that you need, which is sometimes you need to hire talent you can't quite afford yet, and the VC can really be helpful. So you see that a lot. So we have a number of firms who kind of trying to automate that and not be only offering advice at a board meeting, but offering this kind of structured help. And what else? Yeah, the thesis, as I say, should line up to the type of help, if you will. There's lots of general help, but the specific help, and that for me is a real differentiation. If you can offer something that no other firm offers, you know, if it's a consumer company, well, we've just backed 50 consumer companies in a row, and here's our success rate, so we can help you with your consumer business. That's powerful.
Yeah. Yeah. So when you talked about network effects, I think in the US there is NFX fund, which is quite known for also specializing and providing some education on network effects companies. So
Yeah.
interesting that in Europe we also have some firms here. Then, yeah, how do you think? Do you think that LPs use the same approach as fund of funds selecting VC funds? Do you think that your LPs investing in the fund of funds, they also see on the map of the world and go to different GPs and ask, okay, what is the type of, I don't know, fund of funds or LP you want to fundraise, or like they have some different and approach to investing. Like
They
what are
do.
your LPs and what's important to raise a fund of funds?
Yeah, well, the LP behavior I see, they absolutely do use those techniques. I would say social proof, right? So a lot of LPs just look at who the other LPs are. So, I mean, which is lazy. It gives you a signal, but I don't think it gives you the answer, right? So there's certainly lots and lots of funds that have been able to, they were successful at some point, and so they attract great LPs, but they're not successful, you know. So that I think is a dangerous strategy, but it's a very common strategy. Oh, you have these great LPs, so I'll be there too, right? Um, that's one strategy. And fund of funds are used certainly in that way. If you have three fund of funds that I could call, and you see that I see too much LPs who are not really doing their research. What a lot of LPs do because um, funds of all sorts. If you're an allocator, funds are coming to you. So you can kind of sit in your office and they all come to you, of all strategies, buyout shops, and they all come to you. So you might have this feeling like I know the market. The risk of that is the great funds don't come to you. There's almost an adverse selection, right? In sort of that's wrong to say because a lot of the great funds they want to extend their LP base into areas that they're not covering well. So it's wrong to say there's that pure adverse selection. But what I am saying is if you're an LP just sitting in your office waiting for the good stuff to come, you're going to miss a lot. And so what I don't see LPs doing is going out and being really research driven and proactive. And so why do people invest with us? That's one of the answers. They use us as a kind of research scout. And a lot of our LPs say, Joe, we love what you're doing, but we don't have a team that's going to go to 40 countries and meet everybody. And we don't have that kind of time. We don't have that kind of bandwidth. But we'll put some money with you. We'll learn and we'll double down on we'll learn managers that you're investing in, or we'll, use you as a guide, which works really well. We have LPs of all types. We have purely financial investors on one end, and we have like really strategic investors on the other end. For maybe the most strategic are Japanese corporations. We have quite a few Japanese corporates invested in our funds, and they're really looking to Europe for innovation. They've understood that there's great innovation in Europe, but how do I find it? How do I find it early? Super hard. So we said, great, put some money in our fund, come along with us. We'll go to Berlin together. We'll meet some companies. We'll meet some VCs. So that's a really nice collaboration. We have a lot of family offices. It's a dominant form of capital in Europe. Family offices who most of our family offices still own their operating businesses, interestingly enough. So they're long-term operators of a big business, and they see technology being incorporated in their operations more and more. So they invest with us to get a financial return, but quite a few of them also are looking to see what's coming in my sector. What could I collaborate with? And then we have sovereign and foundation and pension money and so on, and more on the purely financial exposure. So if I'm an institution and I'm thinking to allocate to European VC, it's pretty daunting. I don't have time to meet 1,000 funds, right? So you run the risk of just the five that you met, you commit to one or two, the higher dispersion of returns, the more you want to diversify. And early stages, it does have a high dispersion. So we find a lot of institutions like our fund of funds because it accomplishes several goals, gives you a great return, diversifies your risk away, and gives you this education agenda to whatever extent you want. And some people love the education part and they spend time with us. Some don't. Some say, that's your job. Here's the money. Go, go do a good job, which is also fine. And then you have the co-investment side as well. So a lot of people like to join us into companies. Some join us in funds as well. They share our DD. Some even join us in secondary deals. If we're doing a secondary that's too big, we say,
Mm-hmm.
you're welcome to come along and do some as well. So it's interesting to talk to LPs Many are in a learning journey as well. So the way they're investing now, evolves over time, and we're often where they start. Help me map out Europe and understand. And
Mm-hmm.
we go to tech conferences. They come along as well, and you can meet 30 VCs in one go. That's kind of curated, and so that's all part of the fund to fund service.
Super. So LPs need to take more, to look more not only on inbound connections and requests from funds, but also need to map their strategy or the market and do research on what are the different ways to invest in the specific geography or industries. What are the top advice for other maybe funds of funds who want to attract capital from LPs in their funds of funds? So, like, what are specific I don't know strategies you use to meet new LPs, or maybe some I don't know, maybe you use some databases, maybe you do some outreach to LPs, maybe you ask for introductions, or like what are the different ways to attract huge LPs in the funds of funds?
I mean,
So,
I mean, all of that and more is the quick answer. Yeah, it takes a long time. It's very difficult because quite a few LPs are not looking for a fund of funds. The fund
mm,
of funds got a bad reputation in the 90s, I would say, and the 2000s, for destroying returns. Particularly the private equity fund of funds. But that's all changed, and so I think the most powerful way to meet LPs is the intro, is the reference. So our LPs have a good experience with us, and they tell other LPs, and that's kind of that's hard to grow, but that's probably the most rich way to grow. Of course, there are databases of LPs and so on, but all of us as LPs, all of us as VCs, we're bombarded every day by cold email, right? And AI has made it worse. I mean, the number of deals I get every day is really stupid. And most of them are AI crafted. They all follow the same form. It's like, really? Really. So, for marketeers trying to offer their fund to the market, don't do that. Don't spam. You've got to somehow use either your own network or to some extent databases, and just being out there. The conferences provide a pretty good venue for meeting people. When LPs are thinking about committing to venture, they'll go to some venture conferences, and that's where they're kind of learning the landscape a little bit. And so we go to lots and lots of conferences. We talk a lot. We try to do little bit of education on that side. And then I wish there was a magic formula, Max, because I would use it. But there isn't, I think do
yeah.
good work, spread your reputation. The one thing I would say to all funds, and this is true for fund of funds and all funds, you have to have a very clear offer. What is it you're offering the LP, right? It's not just coverage I mean, we're offering something rather specific, Europe, early stage, right? We're not offering you the US or Asia. There are experts who do that. Go there, right? We're also not offering you late stage VC. We don't invest in Excel and Index. They're great firms. They're awesome firms. I did invest in them in my past life. But our idea is, well, if you're a big LP, you can invest direct, right? You don't need our help. Don't pay us. Why are you paying us a fee? Well, you're paying us a fee because we're out there finding the next generation, the things that you wouldn't find that can be highly, highly generative, highly productive, and offer you deal flow and access and all of that. So, you get the idea, right? It's really specific what we offer and what we don't offer. I think that's true of all funds. There are lots of fund to fund strategies. It's really interesting when I talk to other fund to fund groups or just other LPs, how they see the market, how they approach it, what they do and don't do. Just like there are lots of ideas under the sun, there are lots of strategies, and they're all, many of them doing well, but with a very different focus. So it comes back to what's the LP looking for, and if you can
Okay.
understand that and you're offering that, then you have a match.
And how many LPs you need to raise, for example, a 250 million fund? Whether it's like 5 million minimum check, or like what is minimum and maximum check you've got in your biggest fund, for example?
Yeah, you need, I mean, we have something like 40, 45 LPs in the fund, and they range from 1 million, and I'll tell you why, to 60 million. And it's kind of interesting because someone's interest in your fund isn't necessarily connected with their capital capacity. So sometimes and we never know, right? An investor and we have a great discussion. They do their DD, and we never really know until fairly late in the process. Are they putting in 10 million or 20 or two or So
Yeah.
of course, when you're marketing, you're always hopeful they're putting in
Mm,
20. But look, we're trying to be really collaborative. These are our partners, so we want them to put in the number that's right for them. And maybe at this point in their cycle, 5 million is right for them. Great. We're not pushing them. Of course, we would prefer to have 10 and maybe a more concentrated LP base. But yeah, it runs a spectrum like that, right? And then the difficult part comes when they all want to have time and discussions. And so as a firm, you have to somehow give them time and attention somehow relative to their capital. So we have we
yeah.
have small LPs who want to talk every week. And it's sort of like, yeah, I love talking every week, but when the big LP calls, I owe them time too, right? So there's not too much tension there, but there is a little sense of what we do when we're an LP, we try to be a meaningful LP. Like a 10% LP is kind of meaningful. It's a big enough chunk of capital that we can be on the advisory board. Our thoughts can matter, and we don't feel like we're stealing your time when we call you and ask a bit. So yeah, but
Yeah.
it's very, to be clear, it's really hard to raise a fund of funds for lots of reasons. And I think I know most of the fund of funds that operate in Europe, and they'll probably say the same thing. They have a long band of large to small investors
Yeah. Yeah.
that
Understood.
evolves over time.
And is it true that you need to know your big LP at least, I don't know, for 1 year or at least half a year, or like what is the average decision to either ask for capital or for them to make decision to invest? So whether
Yeah.
there were some LPs that put a like 5 or 10 million check just like, I don't know, 2 months after meeting you, or like,
Generally not. It varies a lot by the type of LP. So who puts a check after 2 months? It tends to be if someone who it's their own money, like an ultra high net worth or a family, right? Because they're really betting with their own money. And so they're able to really decide on the fly very, very quickly. The more institutional they are, the more they have a process and a committee and a team and research. There's maybe a larger group of people that they have to bring along to the investment thesis. So yeah, some of those take a couple of years. And I mean, it's horrible to say that because if you thought, you meet people, and maybe you're at the conference and you meet someone and you really hit it off, and they say, "Oh, Max, I love what you do. I'm really looking for what you do because there's a gap in our portfolio." Like what we've heard a lot of times. I understand that Europe is like generating all these great outcomes. If you look at the Cambridge Associates benchmark statistics, Europe is outperforming the US on the fund return level. So I need to be there, right? And so we get all excited. Oh, fantastic. But then it can be 2 years. So we
yeah,
always have to remind ourselves. And why? Well, they have to get to know you, and then maybe they show the proposition to their boss, and their boss has to get to know you, and the boss says, "Well, this is really interesting, but I'd love my committee to get sight of it as well because we've never done tech, we've never done Europe. So then you go talk to the committee, and of course, the further they are geographically, that takes time. So if they're in Japan, you have to go to Japan and meet the team. So you just never know when you have that first meeting, and even when it really clicks, the process and the timing really has to do with the organization, how they allocate, how they do it. Even when we have a fund close, this is another funny thing. we had our secondary fund closing. It already had a highly invested portfolio with a big built-in gain. I mean, IRR over 100%. Like you come in at cost, you have this, and you saw some investment people get really excited, like, wow, I can buy into this portfolio. And then you see, oh, but it's going to take me a long time to get my committee. So how much time have I got? Well, you have 2 months. So
Yeah.
sometimes you can do that and sometimes not. It's highly variable.
Okay. Okay. So VC and I think all the investments are like it's a long-term relationships and game, and
Yeah.
um, it's hard. Maybe for VC funds, individual VC funds, I think it might be. Of course, it's easier to raise than for funds of funds. Yeah, it's interesting for me to what is the difference of your type of support to VCs compared to what VCs support founders? Like, do fund of funds also provide some value to the GPs, or it's more like you said like 10% of capital is quite like substantial commitment, but do VCs need something additionally beyond money or not?
Yeah. Well, we focus on the smaller seed funds, and many of them are younger firms, and being Europe, they're younger firms. So they do need, most of them need and would like to have help, or at least a friendly ear when they encounter difficulties that they haven't before. So that's the benefit of our team being very, very experienced. You've seen problems before that the VC hasn't. And so I think sometimes I'm at my best. I love that moment, to be honest, where a VC calls up like with panic, like, oh my God, an LP, we're still in fundraising and an LP defaulted. Like, I don't know what to do. I don't want to tell the market and I can't fund, and you really see panic on them. And I say, well, hang on, let's think it through logically. And there can be several solutions. Here's what I've seen. Here's what we could do, blah, 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 blah. And so that's really nice because sometimes I have the answer like in my back pocket, not because I'm brilliant, but because I've seen it before, having worked with many, many firms over the years. So that's one form of support. I would say like emergency or moment of truth, or what we do a lot is sort of like a good board member. Um, hey, we have a team issue, or we're thinking to grow the team with this skill set or with that. We're thinking to expand geographically. How would you see it? And I think for the VC, it tends to be a lonely job. There's no one like a company founder, like a CEO. It's lonely in the sense that they don't necessarily have people they can talk to. They're running their business, they're managing people and process, but who do they call when they want to think in a blue sky kind of way? So we act that way for lots of VCs. Um, and I think that's when I'm at my best, to be honest, when they feel comfortable to call me with their problem. And if they're not comfortable, I've messed up, right? They should be like Joe's trusted, or Chris on our team,
Uh,
or Chloe on our team. I really trust Chloe. I'm going to call her up and tell her something which I wouldn't tell others because it's embarrassing or a problem or whatever. So that's, I think when we're at our best. Then there's a whole range of things we just do normally. We act as a reference. So we put money in the fund early, and then we talk to other LPs. We share our thoughts on firms. We sometimes interview people who are being considered to be hired. We act as a sort of, again, outside friend. What I've discovered is many VCs don't have anyone on the outside who thinks about their business, who understands their business. They're figuring it out themselves. So to have a friend who knows them, who thinks about their problems and their challenges, that's valued at some of those key times. So back to, do all fund of funds do this? I think many do. It depends what you're investing in, right? I think if you are maybe investing in the index, in the Excel, they're not calling you for advice. They don't need your advice. They don't want your advice, right? I mean, they've been doing what they do for 25 years, um, and so that what help is needed and how often and so on is really a function of the investments underneath. And I love that. And usually in that moment where we can help, it's also a moment to get closer. So we figure the problem out, and then we say, yeah, what's happening in the portfolio? Which companies are popping, and any co-investments coming up? There's always, which is quite fun, right? You have a touch point, you solve a problem, you start to move into the next thing. Anybody thinking of selling? Because we're looking for secondaries. Love to buy some more of your fund. That's quite fun when we do a primary, and then like 5, 6 years later, we buy some more. Love the way the
Uh-huh.
fund's developing. Anybody looking for liquidity? And that's often how we create deals. So most of the deals we do are not on the market. They're not intermediated or anything. It's really that you're having such a discussion and you create a deal. Oh yeah, actually, funny you mention it. Someone asked me last week if there would be any buyers because they have another project and they need cash. That's often great. Some of our best secondaries have come out of that kind of discussion.
Super. So you said about how LPs invest, but when you invested in almost 100 funds, what was the fastest decision from meeting the
Oh,
GP?
yeah, that's interesting. In the early days of Isomer, we invested with people that we had known for years before. So that's the network effect. Um, and that tends to be more comfortable, right? We've observed them in their prior work. Maybe they've had prior funds in their current firm and then they have a long track record. Or maybe they work somewhere else and we knew them there. That's quite common. So that's, the funny answer to you is most people we invest with, we have known already for some years.
Mm-hmm.
However, you're pushing me on the speed point. We have last year met a couple of really interesting new ideas. And I think we went from idea to investment in 2 or 3 months.
Mm.
And we don't do that a lot, but we can do that because we can do diligence it kind of from a 360 point of view. So we may not have known the team, but we know a lot of people around them. So people they've invested with and the co-investors, right? So that's often how we're doing our work. We sit at the table and we go, well, this is moving really fast. Like it's super hot fund and people are throwing money. We did two of those last year. Probably shouldn't mention which ones, but we did two of those where they were like clearly everybody wanted to be there, right? And so he said,
Uh-huh.
if we want to be there too, we got to do this really fast. And it was
Uh-huh.
true.
Uh-huh.
They had more money than they needed. And I think both cases they raised the hard cap a bit, too. And so he said,
Yeah.
okay, we don't know the individuals, but what we do know is a bunch of the companies they backed and the co-investors. So then you can start, that's the power of the network, right? You can call up and say, hey, you were on the board with this one. What was that experience like? And hey, did you do a seed deal with these guys? Blah blah blah. Oh yeah, yeah, and you can collect a lot of information. It's not in the data room. It's not. But what are you trying to figure out? Back to that question: does a great founder want money from this team,
Yeah.
right? And if you hear from all over the industry, what few of our VCs the market universally loves them. Oh, she's amazing. Once they're, oh, she's awesome. There's one quote we have in the firm of one guy. There's always room for him on our cap table. It was
Mm.
the
Yeah.
nicest. It was really a compliment to the guy, and we wrote it in our investment memo that whatever's going on because of that reputation, because of that history, we will make a space just to get that person. That's one particular person, but I was thinking about a solo GP that we backed who's just loved by everyone. And it started becoming a joke, like every reference call, she's amazing, she's awesome, blah, blah, and we come back to the table and say, well, how did your references go? Yeah, everyone loves her, everyone. So you build a
Yeah.
picture, right? And
Yeah.
then the interesting thing is to look at failed companies, right? If you call a founder where the company failed and you see how the story went, how the behavior went. We did that once where we made a co-investment in a team that had the prior company had failed. And so I was able to call up their investor, which they didn't know, but I knew, and it was an easy call. I said, "Hey, you backed this team, it didn't work out. Would you back them again? How was the experience?" And I got the whole story. So that
Uh-huh. Uh-huh.
triangulation sort of call it the 360 DD, but that's the way we figure it out. And if you spend 20 years building that network, then you can do that and act quickly. So I don't think it's irresponsible to do a commitment in 2 or 3 months if you can do that. Or even on co-investments, it's even faster, right? We may have a week. So if you have, that's always the question. Who do we know? Who do we know? And if you know a group, great, we can do it. If you don't, you have to be honest and say, well, we don't really, we can't really figure this out.
Super. And were there examples when you invested in some fund managers, they're raising a new fund? It's not more than 250 million, so I understood that you don't typically invest in big funds. But were there some examples when you didn't invest in their next fund for some other reasons, like maybe performance or some other? So what were the reasons that can let you not invest in the next fund?
Yeah, well, the main reasons that's an extremely difficult decision to not effectively not re-up in a follow-on fund, right? The main reasons are something's changed. So the original thesis was a certain fund size, a certain stage, a certain team, and most often some of that changes. So the team breaks apart. Pretty obvious when that happens, right? Well, who's running the new fund, right? Or the fund gets too big. We really back 50 to 150. It's kind of our whole universe. And so if you're raising 200, well, we love you, but we're really looking for that first check investor that isn't mostly follow-on money, right? When the fund gets bigger, if they're still doing early stage, then most of the fund's going into follow-on, and it's not often clear at that moment are they good at follow-on or not, right? So that's kind of an easy no. Say we do 50 to 150, and you're going out. So I'm super happy for you. It means they've been super successful, right? And it's kind of annoying because we know each other well, we like each other, we've been working together. So sometimes we can bring them some of our LPs. Say, look, this is out of our thesis, but we'll put you in front of some LPs that may want to join. So that's exciting. Scope changes, right? Where the scope of earlier focused funds is really tight and we think can really win. And then all of a sudden it goes too broad, and it can go sector too broad, geography too broad. Oh, we're going to do half the fund now in the US. Oh, but really? But are you really competitive in the US? Like, are you really the money of choice in the US like you are in your home market, for example? So in a way, what you're looking for in the re-up is kind of what you might call the gap analysis. What's different, right? And if everything is the same and performance is good, so performance is always a thing, right? We've committed painful decision, but sometimes we've committed a lot of money to a group and we haven't got any of it back. No DPI, right? And so that's an extremely tough decision because you may still like the thesis, love the team, but we have to deliver to our LPs. So there's a tough choice, for example. But it's really this gap analysis. If all things are equal and performance is good, we should re-up.
Okay. What are the three, like, your favorite funds of funds that you think that you admire and think they're a great example?
Other fund of funds?
Yeah.
Well, I always, from my very early days of learning what venture capital is, I always looked up to Horsley Bridge. Horsley Bridge, amazing firm in the 90s, and I was able to learn from them in my early career what venture is and how it works and all of that. So I think they're a remarkable firm over the years, and every time I don't talk to them super often these days, but every time I do, I learn something. It's great. And I think there are really specialists. There's a micro fund in Germany, Multiple, run by Ayrton. He's kind of a comrade at arms in the market. I think he's a deep thinker. He's a first principles thinker. And so we sometimes share notes together, how you're thinking about this investment or that. Yeah, who else do I kind of look up to on the fund to fund side? I think, we developed our strategy, and there weren't really others doing anything like what we do. So it's not like we copied. We really thought about, well, what would be a great way to play Europe? So there are fund of funds that are US in origin or doing some Europe. There are small ones growing, um, and there are elements of them, right? So I think the fact that we combined co-investments and secondaries, that came from day zero, right? That's not something we evolved over time. Oh, how can I forget what used to be Greenspring, right? So one of the founders of Greenspring, before it was called Greenspring, is an old friend of mine, and I talked to him in the early days. How did you make your firm, and what were the successful strategies and losing strategies? And that was sold to Stepstone some years ago, so it's very different now. But I watched their evolution and what they did, and yeah, learned a lot from them over time.
Super.
So yeah, there's a lot of good groups out there.
Yeah, and what is the necessary track record or some qualifications to launch a typical VC fund and a fund of funds? So do you think those are different? So for example, for typical VC funds, people start angel investing, and especially when they show great DPI to themselves in I don't know 5-10 years, and they can show like that they are outperforming the market several times. So I think this is great position. What are other like types of previous track record that can allow you to launch a VC fund, and what is the necessary qualification? So I understand you have like 30 years of venture capital and investments, and this is definitely so. When you started like 11 years ago, it was like the everything in VC. So but did you see other career paths or track records for launching a fund of funds also?
Yeah, well, I think that about VC funds, as you described a little bit of it. It's a sort of what it would be the skill set to run a successful strategy and firm, right? And so there has to be something about investing, there has to be something about operations, strategy, marketing. If you can't raise, you can't run a fund, right? So you have to have fundraising, you have to have the operations part, finance. So in a fund of funds, clearly an understanding, ideally down to the asset level. I mean, we have founders on our team, right? When I studied computer engineering, and I didn't, to be honest, I hadn't seen that in fund of funds before. So there was a criticism of fund of funds in the old days that they were really disconnected from the assets. And when we started, I thought, well, we should try to combine a tech experience with founding experience with asset management experience and put that all together. And that would potentially be a powerful combination to know it all, right? So when a VC says to us, "Oh, you don't know how hard it is to fundraise." Yeah, we do actually. And when a founder says, "Oh, you don't know how hard it is that I just had to fire 20% of my staff." Yeah, we do actually. And so we have people on the team who've done that in the past. And so that was, my model is, if you think about all the underlying activity, if we could have that somewhere in our team, that would be super useful, because you don't know what advice people might want along the way, or what would factor into your analysis of an investment. You can't know everything, but you can try to build a diversified team with different experiences and different points of view, um, that whatever comes up, you've got a good chance to understand it. Or at worst, someone who says, "Hey, this is beyond us. We need to call an expert." Sometimes if you're really looking at some technology you don't understand, hey, who can we call to figure that out, right? So that's sort of my model for fund of funds. When we started, again, we leveraged outsourced back office operations. I think that's quite important, and most VCs in Europe do that. So you hire the best, or you rent the best rather than hire. Sorry, um, and that's been a extremely useful thing for us. So we could keep our team really focused on investing, and then leave fund accounting, audit, admin, all of that, leave that to experts. So from day zero, we had really, quite an expert team. We didn't start making mistakes and figuring it out. We started with the best platform you could start, which is important. And then on the investment side, founding experience, tech experience, management experience, all of that. But I guess
Mm-hmm.
if you
Mm-hmm.
ask, as you ask more fund of funds, you'll get very different answers,
Mm,
connected to their thesis or their part of the
yeah.
market. The American fund of funds will tell you access is the key. How do you access, right? How do you
Mm, mm, mm,
convince Sequoia to let you in? And that
yeah.
that could be a really big metric. I think for us, we built it, we had it, some of it already, and I'm conscious that brand matters, and you know, being a good partner really, really matters. It's something we work on every single day. That if someone, what I want is that if anyone in the world calls one of our investment partners and says, "Well, should I take Isomer's money? Like, are they good?" Back to that thing, with founders, that someone will say, "Oh yeah, yeah, I know. They invested with us. They're terrific. They're helpful. They do blah blah blah." I want that positive flywheel, and that helps us win deals. Actually, where sometimes money is a commodity, and you win on those metrics of, well, if you take Isomer, you get all these other things. You get access to their network, and you get. So yeah, there's a thousand points of assistance, which we think about and try to bring to bear.
Yeah, probably my will be last questions about the fund of funds, but it's interesting. What do you see? What is the size of market, or like how many funds of funds exist here, um, in the world, in the US, in Europe, and whether there are some specific, I don't know, communities or conferences or something specifically for funds of funds? I don't know, a WhatsApp group or anything else that connect all the funds of funds together.
A
Or you're
support group,
competing. Yeah,
a
yeah,
support group for fund of funds. No,
yeah,
maybe we could start that, Max. You want to start that one?
yeah,
Um,
yeah. So minimum will be 100 million AUM. Yeah, we'll launch a WhatsApp group.
okay, if you get 100 million, you get in this WhatsApp group. It's funny when we meet each other, in the market, in conferences and whatever. We quite enjoy talking because we have, like everybody in the same business, you have lots of challenges in common. And in Europe, there's not a lot. There are, I don't know, between 10 and 20, I guess it would be the number. Unfortunately, most of the fund of funds in Europe are government.
Mm, mm.
If you really look at who's funding European venture capital, it's sort of 40% government money, and the central one being EIF, and then you have the British one, the German one, the Finnish one, the French one. So every country has developed its own fund of funds, which tends to be government money, although some of them are raising private capital, which I think is weird. I think they crowd out the private market. So that is really a European problem in my estimation. Of course, that money was needed to make the system vibrant and scalable, but these days I think that money has the effect of crowding out commercial propositions, especially when it raises private money. So the fund of funds community is growing. Private banks, so certain private banks sponsor kind of a fund of fund with a small team. There are a few pure plays like us. There are a few that are attached to corporations or other things, but the biggest ones in capital terms and commitment number terms are the governments in Europe. That's not true in the US, right? There isn't the government context. There was government money in venture in the very early days of venture, but it's shifted to private. Um, the number of fund of funds in the US, I don't know anymore. I used to follow it really closely. I don't know. A lot. A lot is the quick answer. And then you have fund of funds for all the different market segments, right? For real estate, for
Uh-huh.
infrastructure, for private equity, for small private equity, for big private equity,
Yeah.
and they have evolved to in line with the asset market evolving. I have the luxury, what for me was great fun, to really focus on my passion of VC, and tech. And so I kind of I watch every single day what's going on there, but I tend to watch a bit less the bigger market.
Yeah, sure. So I'd like to cover a bit secondaries in this interview. So let's try to um, understand what are the type of secondaries that exist. So, for example, a founder willing to sell their shares at the later stages is one secondary. Maybe there are LPs willing to get liquidity, another type of secondary. So, if you can give an overview of different type of deals that exist in secondaries, would be great to understand.
Sure, sure. So venture capital secondaries, especially in Europe, are relatively unsophisticated relative to private equity secondaries. But private equity secondaries have evolved over since the early 90s, basically, till now. So we've got a long history of people figuring out solutions to liquidity problems. Ultimately, a secondary is a liquidity problem, right? Someone needs or wants to sell an asset and you need a buyer. And so, yeah, the simplest form is what you describe, a company. There's a shareholder in a company and they want to sell their shares, right? And that can be the employees, the founders, the angels, the early investors. That can be people who got warrants that converted, or whoever, right? And so someone comes along and buys, and it's subject to the company's approval, and it's subject to price agreement and whatever. But pretty simple, right? Private share, purchased, done. Um, the next thing is the VC funds. So those are all structured as limited liability partnerships, and they're long, right? They start out as 10-year vehicles. We bought one a year ago that was 18 months ago. That was a 13-year-old fund. So, they don't all end at 10 years. And this was a 13-year-old fund where some of the LPs said, I've been waiting a long time. And the fund was very high performing. So they said, I'd love to take some of my money off the table. On paper, I have this great return, but I'd love. So someone comes along like us and makes an offer and says, well, I will replace you as the LP. So either I'll take your whole position or half your position or whatever, and I'll become an LP, right? So it's kind of, you could call it LP replacement. And that's what we tend to focus on because we're an LP in so many funds. Then as those funds age, you get groups who get distressed, or they get over allocated, or they simply decide not to do venture anymore. You see that sometimes, right? Where maybe a pension fund will get a new CIO, and the new CIO says, "Oh no, we need to reduce our illiquidity profile. We're cutting the private book by 50%," or that kind of stuff. So that's fund positions, and you can have. So what is a fund? It's a basket of companies with a wrapper on it, right? You can also have a basket of funds. So if let's take the example of a pension fund, maybe they invested in 15 VC funds and they offer that to you. We bought one, and so you have all derivatives of this, right? We bought a Holdco. So a corporate VC had made a series of company investments in a Holdco, and they wanted to new CEO, new strategy. They wanted to uh, stop that corporate VC activity. So we bought the company with all the things inside of it. And then you get some more fancy things. So a VC could say, well, I have a portfolio of 20 companies and they're doing really well, but the fund is getting old and there hasn't been enough liquidity. So there's something called a strip sale. What if I sold not any of the companies, but what if I sold, let's say, 10% of each company
Uh-huh.
to a new buyer, right? So we could create a new vehicle. We could sell into that vehicle 10% of each company. That money would come into the fund and be distributed to the investors, and the new investor would own a kind of synthetic fund, right? That's called a strip sale. So because of it's buying a strip of the fund. And that, fund managers find that interesting in the right situation because it's a way to give DPI back, but keep your star assets, right?
Uh-huh.
So anyway, and it goes on and on to different. Sometimes you can't have approval, so you'll create a derivative structure. You'll say, well, I won't buy the thing, but I'll create a virtual, so an option to buy in certain cases, or I'll get the first cash flow like a debt instrument, or that gets really complicated. We don't see those sorts of things yet in venture. We see really a lot of company deals, that's the primary, a lot of fund deals, some portfolio deals where there's a mix, blend of all of that. We start to see strip sales, and we're
Mm-hmm.
not yet seeing the really, more exotic things, which are common in the, and there's the bigger the portfolio, the more people are able to do sophisticated solution. If it's something small, us and others, we just buy it, keep it simple, right? For a small amount, you can't afford very expensive lawyers to do all this fancy stuff. We say, look, here's a price, we'll buy it, done. You're happy, we're happy.
Mm-hmm. Mm-hmm.
That's the best. And then, well, maybe one thing worth mentioning is sometimes the transactions have an amount of structure. And what I mean is, if you can't agree on the price of the thing, you'll make a deal where you say, well, look, Max, you think it's worth 100, and you want to buy it for 100, but I think it's worth 200. And we're not going to meet in the middle, right? It's just too big a gap. And so let's say I'll pay you 100 today, and at the time of exit, depending on what the exit price is, you'll get an additional payment. Um, or the seller will get an additional. And that's a way to kind of balance a big price discrepancy. And again, it requires some heavier legals and all of that, but that's a structured secondary, right? And you see
Mm-hmm. Mm-hmm.
different forms of that.
Mm. What are typical discounts when you buy different types of secondaries? So how
Oh, in
much
venture,
can you earn? Yeah.
yeah, in venture it's all over the place because discount is a virtual number. It's not a really meaningful number.
Mm-hmm.
Discount is the price being paid relative to the holding value, right? And the holding value can be anything, right? If you have a holding value um, that's 5 years old, it may not be relevant at all. For example, right? The company hasn't done a funding round in a long time, so the holding value is something, but maybe the revenues increased 1,000%. So maybe you don't pay any
Mm-hmm.
discount, right? Because
Mm-hmm.
actually, maybe you pay a premium even, because the real value of that company has far exceeded the so-called value. More often, the reverse is the case. So, company just did a funding round. It's like a multi-unicorn, but the revenue is very small. So when you analyze that from a revenue growth curve exit standpoint, yeah, I see that your holding value is here, but we bought something where the holding value is from 2021, like a really high multiple,
Mm-hmm. Mm-hmm.
and it was an attractive company growing really well within a fund, but the star asset in a fund. And we said, this is great, but you're holding that at such a high price. If you exited that company today, it's not going out at that price, it's going out at this price. And so we're just not willing to pay that. And the VC in question, I said, yeah, of course you're right. Yeah. So we entered into the discussion, well, what would be a fair price, right?
Mm-hmm. Mm-hmm.
Because so in that case, the optical discount was high. Doesn't really matter in the end. We're not making money because of a bigger or smaller discount. We're making money if that asset goes on to a great exit, and the price we paid was good relative to the exit. So the shorter answer to your question is, one of the best secondary deals we ever did had zero discount.
Mm.
Just to give you an example, right? Because it was already sensibly priced. We've done secondary at 50% discount. That was not a good deal. So the discount provides you a margin of error, sometimes risk protection, and so on, but it isn't the answer to the
Mm-hmm.
return.
Mm-hmm.
Um, and what do we generally see? Something between 20 and 50. If you really, if you force me to average out all the secondaries we've done over the last 5 years or so, it usually lands in there. But it's not that we come in and go, oh, I'd like to just have, 25% off. No, we do the bottom up. What would be the exit outlook for this fund or this company? Discount back by my target return, and there's my price. And so if you're holding it high, high discount. If you're holding it medium, smaller discount.
About secondaries, also, when do you think, like, whether it's good for founders to make to sell some of the shares before exits. And like, what is this good example and bad example of a founder who sells earlier? Uh,
Yeah.
yeah, so of course it might be attractive for secondary investments, but do you think that there is some sort of, I don't know, rule of a thumb? What is a good type of founder secondaries or not?
Yeah, I think there's within the VC community, there's pretty good agreement on this that um, a founder who's created a lot of value through hard work over time, it's a very nice thing for them to take some money off the table because it can improve their life, right? So um, we hear quite often stories that, hey, I've been working 7 days a week for 10 years and I never see my family. So if I could sell a bit of my shares, we could buy a better house, we could go on a holiday. I think that's a really good secondary because enabling the founding team of a company that are really creating the value, enabling them to improve their life a bit and keep building. So the alternative often, too often, is they sell the company. So they sell the company at 100 when if they held on for a few more years, it could sell for 1 billion. You see that we see that sometimes where you just know it's going to be great, but the founder's tired and they know they have value on paper. And so a good secondary enables, an easing of life challenges whilst helping them keep building, right? I think a bad secondary, and the company goes on to be successful and everyone makes money. And it's a small part, right? They sell 10%, 5%, something like that, right? A bad secondary is where the founder or, well, stick with founders. You mentioned founders, but people who are still important to value creation in the company. If they've left, it's a different thing, right? Or if it's an angels, it's a different thing. They're not important to create the future value, but if they're there and they're running the company still, and they sell too much, they maybe then get distracted. They go buy a fancy car instead of working super hard, and so this loss of motivation, and they used to own a big piece of the company, now they own a tiny piece. So there's something about the proportion of it, something about the timing of it, and a bad secondary, which we did see in the 2021 period, where the company's overvalued. Somebody buys at a high value and then the company goes on to be lower
Mm-hmm.
valued,
Mm-hmm.
or even worse, fail. And then the founder walks away with money and all the investors don't. And I think that's a bad secondary. And bad things can happen in all investing, but sometimes you kind of can see that coming. And I
Mm.
think that's the secondary buyer's fault that they, but anyway, you get the idea, right? Good
Yeah.
secondary enables the growth curve
Mm-hmm.
and all investors to prosper. Bad secondary creates bad behaviors
Mm-hmm.
and
Mm-hmm.
even in bad cases, bad outcomes.
Mm-hmm. Okay. Yeah. Um, the biggest number of secondaries, does it happen in LP secondaries, or like what is the market? So I'm just trying to understand whether it's mostly primary or
The
uh,
biggest number happens in company stakes. So I think, well, in Europe today, probably most secondaries happen as part of a funding round. So
hmm,
the BCD round of a company, right, where you see a part of secondary offered to the team, right? You're doing a D round and the new investors coming in and they say, well, we'd like to own a bit more. Can we inject some secondary where we inject our new money, but we also buy some existing shares, maybe are converted to pref, maybe not, but and that has that effect on the team sometimes, or cleans up the cap table, and so that happens a lot now. Didn't happen so much 10, 15 years ago, but it happens a lot now, and it's kind of hidden. It's not spoken about. You don't see it in the press and so on. Sometimes it's announced. Quite often it's not. Just under the radar. And there are good ones and bad ones at that. We get many direct deals every day. So people who've, for whatever reason, just want to sell the company. And we see good ones and bad ones, and people have realized there is a growing private market, and so they just
Mm,
try it.
mm,
Hey, I'd
mm,
love to sell you this for a crazy high price. Okay,
mhm,
well,
mhm,
that's not for us. So that we see a lot. LP secondaries are still not too common. That's where we focus, and partly because there aren't a lot of buyers for those things. So if you're an LP that needs to sell, particularly on small early stage funds, getting data on those funds, getting approval from the GPs and so on, it's hard to do. So we have a position in the market, we can do that. But yeah, those are more rare, and quite often we create the deal. We kind of say to the GP, hey, we'd be interested to buy your fund one or your fund two. How about we make a price and you offer it to all LPs, and we see what happens, right? So that happens quite a bit. Or someone leaving the industry completely, the pension fund example, we see that a bit. It's not so common. And or the family office, right? Or what happens in cycles is that during the up times, 2021, people commit too much money. So then you see some secondaries later. Oh, we shouldn't have allocated. We should have stayed with our plan of allocating a similar amount every year. In a couple of years, we went a bit too crazy. We allocated way too much, and now we can't re-up to our good funds. So we want to sell some of that and that's LP rebalancing. And that's kind of interesting. But that's still in Europe pretty rare. I think in US, pretty common because there's a big mature group of buyers and sellers there.
mhm. Yeah, and you also have, I think, a lot of experience in private equity. What do you think about private equity these days in Europe, and how do you compare it to VC and to secondaries? So where do you think are the biggest opportunities today, for example, in Europe? And also, if I understand correctly, the investment world, so like public markets, you can, like, it might be difficult to outperform it, but with like some private deals and some like VC, for example, you can have crazy multiples on some of the companies which will deliver you, I don't know, maybe 20-30% IRR potentially. And secondaries also, like, it's not transparent market. And if you understand really well what is the valuations of companies, what is the traction of those companies, so you can do great math and uh, like earn a lot. But what is your comparison of these three assets? Let's say private equity, venture capital, and like just secondaries across all different types of deals.
Yeah. Well, I mean, private equity is a mature, sophisticated market. There are great returns to be made there. Private markets are growing relative to public. There are fewer stock listings year on year, and private markets keep growing. So I don't see that trend reversing anytime soon. And I mean, there are people who do that extremely well. There are funds, there are fund of funds, continues to be a great opportunity. Personally, I think you can make higher multiples in inefficient markets. So, smaller companies, where classic private equity is smaller companies where you can improve the management, grow the company, and sell it, the old school. And there are many, many models. There's distress, there's, all kinds of different ways to make money. It continues to be a great opportunity. The dispersion of returns are rather narrow, right? So the difference between a really good one and a really bad one has narrowed over time. In venture, very different animal, right? A totally different animal. You're building companies, you're growing companies. The dispersion of returns, if you're investing early, is really high. You can lose all your money. You can make 100 times your money. I mean, it's really, crazy, right? So you have to diversify to get a couple of 50x's in with all your zeros. Um, but if you diversify and select well, you should outperform, right? All private should outperform public, and quite a lot of it does. I mean, we must outperform public, or else we don't have a firm. So that's not a question, right?
Yeah.
We need to outperform public, or else we don't have a reason to exist, and outperform it by a lot. So venture, I think, is a wonderful opportunity. That's why I dedicate my life to it, and building the firm and supporting all those underlying companies. Um, but it's a difficult and different way of investing. So you need to apply a different strategy. And then secondaries are, a subset of the two. So buying private equity secondaries is very different than buying venture secondaries. Private equity secondaries, you're buying profitable companies on EBITDA multiples, you're levering it. And there again, in the 90s, the dispersion of returns was high, but now it's come down. So it's very tight. Again, the difference between a low performing secondary fund and a high performing one is pretty narrow, right? You're not going to get 5x out of a private equity secondary fund, right? Um, Ventures, again, a very different animal. You're buying these companies that have this crazy growth trajectory so that you need to diversify and so on, but you really can have a good shot at 3x out of a secondary fund if you get it right. The bigger it is, the more diverse it is, probably the more average, returns revert to mean. But what you're really trying to do in venture secondaries is buy growth. Tends to be unlevered, right? And so if you get it right, you can outperform, but you're subject to the cycle, the exit window, the IPO window. So there again, it's private equity is subject to the cycle as well, but a little less so, right? It tends to be more steady. So yeah, they're
Okay.
all great opportunities, but your strategy, when I was building large portfolios, I would do some of all of it, right? I don't think it's either or. I think
Hmm.
in a balanced portfolio, you should diversify because there are times in the cycle where one's doing really well and one less, times where the reverse is true. So diversifying across them sensibly, I think builds you a really robust growth engine for the future.
Super, Joe. And my last question will be, what are your recommendations for books for investors? So do you have some favorite ones that you think are great for different types of investors or for VCs, for example?
Oh yeah, it depends. Depends where you are in your investment career. I think when I was learning about the endowment model and so on, the David Swensen books were super important, right? Learning about the endowment model and um, portfolio management and so on. Those were so. Well, when I advise younger people, I think some of those classics, if you really want to go back, it's Warren Buffett and Charlie Munger's writings and so on are really
Yeah,
great.
I have this picture.
Oh, you have behind you, yeah.
Yeah,
I mean, they're so common sense is so uncommon, right? And they have this beautiful way of distilling concepts to a simple thing. You know what? I've One of my friends has forced a book on me recently called Thinking Clearly, and I find it really interesting. So we all have human biases, and the problem with investing is it tends to be quite a personal thing. And if you don't know your own biases, you'll follow them, right? And your own. So I think we all go on a journey of trying to learn ourselves and trying to take that out and use analytical eyes. And venture is a weird animal because you need to get close to people and understand and find intelligence which is off market and so on. But you also need to keep your structured mathematical brain. So I'm reading less investment books these days and more things like that, which are really helping me think more clearly. And in
uh-huh,
that case,
uh-huh.
kind of an interesting book if you have a chance.
Yeah, super. I read Super Thinking, which was also probably based on Poor Charlie's Almanac. So
Uh,
those are two great books about our thinking models and biases and psychology.
yeah,
So yeah, super,
fantastic.
Joe. This is a very interesting conversation. So I learned a lot about it, and I hope our listeners also. So thank you so much for joining.
Well, thank you, Max. I love talking about these topics, so I hope it does prove interesting to some people. And as always, we're in the market for the long term, so happy to talk more.
Great.